part D. Prepare a memorandum to the management of Bulletin in which you explain how the capital investment appraisal should be performed and other factors that should be considered before investing in the online media platform. So please just be careful, guys. There's two parts to the required over here. So let's just circle that and so that we make sure we answer both parts of the required. Then there's one mark available for communication skills, and that is awarded for layout and structure. So the communication skill mark is going to be awarded for presenting your answer in the format of a memorandum. So let's have a look at that first, and then we'll look at answering the required. Clearly indicate that this is a memorandum. Then you need to say who the memorandum is to, and that comes directly from the required. You were told to prepare a memorandum to the management of Bulletin. Then, who is it from? You are a CTA candidate, or you are a RTC candidate, or an APC candidate, etc. Don't put your name there. Don't put a fictitious name there because the marker won't know that it's a fictitious name. They'll think it's a real name. Don't put names. Just say CTA candidate, RTC candidate, APC candidate, whatever you are, all right? Don't put your actual name there. Guys, if you put your name there, you're not going to be awarded the communication skill mark. Remember, the marker is not supposed to know whose paper they are marking. You then include the date. After that, you include the subject. Once again, this comes directly from the required. You need to explain how the capital investment appraisal should be performed and other factors that should be considered before making a final decision. Then if we just scroll to the end of this question, please make sure that you also include a conclusion. So you don't have to go into a lot of detail over here, just something along the lines of, I trust you will find the above helpful. Please contact me should you require any further information. That's perfect. And if you've done that, you can award yourself the communication skill mark. All right, so like I said, the required has two parts. So let's focus on the first part. We need to explain how the capital investment appraisal should be performed. So if we go back to the information provided in the scenario, under the heading Future Initiatives, we were given information relating to the investment in the online media platform. And you were specifically told that management wants to assess the investment over an initial period of 5 years using the net present value method. So we need to explain how the capital investment appraisal should be performed using the net present value method. So how would we assess this investment using the net present value method? Think about how you would perform the calculation, and you now just need to explain how you would perform the calculation. So if this was a calculation, you would start by drawing up your table. We know that management wants to assess the investment over an initial period of 5 years, so we need to have a column for each of those years, and we also need a column for the beginning of year 1, which is column 0. So we'd have column 0, 1, 2, 3, 4, and 5. Okay, and we would draw up our table. So just think about what you would do, and then it makes the explanation a little bit easier. Next, we would include all of the cash flows relating to the investment in the table. So include all of those cash flows. And remember, what is the logic that we follow? We follow the principles of relevant costing. We only take into account future cash flows that arise as a direct result of the investment. So most of the marks, or a lot of the marks in the suggested solution, are going to be around explaining how we determine which cash flows to include in this calculation. Then, once you've included all of the cash flows in the calculation, we are going to calculate the net present value. So we are going to discount all of these cash flows to the present, and we are going to calculate a net present value. And remember, when we are calculating the net present value, we use the target WACC of the company as our discount rate. And then once we've calculated the net present value, if we have a positive net present value, it means that the investment is going to create wealth for the company, so they can accept, or they should accept, the investment. On the other hand, if we calculate a negative net present value, then it's going to result in a deterioration in wealth for the company, so the investment should not be accepted. So that's pretty much the logic that we follow to our calculation. Now, this can't just be a memory dump from your lecture notes. You've been given certain information relating to this investment decision in the scenario. So you must use the information that you've been provided with in the scenario to structure your answer. So up front, you were told that the majority of revenue is going to be earned from advertising. However, customers who want to read articles without advertising will be required to create an account and will be charged a monthly subscription. So there's two sources of revenue, advertising and monthly subscriptions. Then just below, you were told that a feasibility study has been performed to determine the expected revenue that will be earned from advertising and monthly subscriptions, and fees have been calculated using existing selling prices and adjusting for savings in paper, printing, and distribution costs. So obviously, the expected revenue that is going to be earned from advertising and monthly subscriptions will need to be included in our capital investment appraisal. And those cash flows will be included in years 1, 2, 3, 4, and 5. And all of those will obviously be shown as cash inflows. Then for the feasibility study, this study has already been performed. So guys, this cost should not be included in the calculation because it is not a future cash flow. It is a sunk cost and should therefore not be taken into account. Quotes have been obtained for hardware, software development, and graphic design. So these are all of the initial costs that the company will incur before they can actually start using the platform. Obviously, they need the hardware, they need the platform to actually be developed, so that's the software development, and they need the graphic design, obviously, so that the platform looks nice when users are on the platform. So all of that will have to be done before they can start actually using the platform and generating income from the platform. So all of these costs over here should be shown as an outflow at the beginning of year 1, or in other words, in column 0. Now remember, it doesn't matter if Bulletin doesn't actually pay for all of these costs up front at the beginning of the project, because we always look at the investment decision in isolation before we look at the financing decision. And the assumption that we make with the investment decision is that these costs will be incurred up front. So we always show these as an outflow up front. And remember, financing cash flows are not relevant to the investment decision. The financing decision happens after the investment decision. So all of the financing cash flows that we have over here should not be taken into account in the investment decision. The financing cash flows are not relevant to the investment decision. We ignore how the investment is going to be financed. We assume that all of these initial costs will be an initial outflow at the beginning of the project. So we will show all of those costs as an outflow in column 0, or the beginning of year 1. You were then told that annual operating costs have been estimated and include salaries of IT personnel that will be appointed to deal with any unexpected problems and perform ongoing maintenance on the platform. The cost also includes depreciation of hardware and amortization of development costs, which qualify to be recognized as an asset in terms of IAS 38. All right, so these annual operating costs over here, including the salaries of IT personnel, because the IT personnel are being appointed as a direct result of the investment. If they don't develop the online platform, they won't appoint the staff. So this cash flow arises as a direct result of the investment and is therefore relevant. So the annual operating costs, including the salaries of IT personnel, should be shown as a cash outflow in each of the years, in year 1, 2, 3, 4, and 5. However, the depreciation of hardware and amortization of development costs is not a cash flow. So it doesn't meet the definition. It is not a future cash flow. So depreciation of hardware and amortization of development costs should not be included in the calculation. And any other non-cash items should also not be included in the calculation. All right, so that deals with all of the information that you've been provided with in the scenario. You now need to take a step back and consider whether there's anything else that should be taken into account in the calculation. So what am I talking about over here? You know from our lecture on capital investment appraisal, when we are performing a capital investment decision using the net present value method and we are estimating all of our cash flows, working capital requirements need to be taken into account when we are estimating our cash flows. And the reason why we take the working capital requirements into account is normally when we estimate all of these cash flows over here, we use accounting profit as the starting point in our calculation. And accounting profit obviously includes non-cash items because accounting profit will include things like credit sales, credit purchases, etc. So we have to take working capital into account in order to convert accounting profit into cash flows. So that's another discussion point that you can include in your suggested solution. In addition to that, we also know that this target WACC over here, or the WACC of the company, the WACC of the company is a nominal rate, which means it has been adjusted for inflation. It includes the effect of inflation. So if the discount rate includes the effect of inflation, then all of these cash flows over here should also include the effect of inflation. Okay, so obviously not the cash flow, in column 0. There you won't have any inflation because that's now. But all of your other cash flows, you should adjust all of those cash flows for inflation because the discount rate is also adjusted for inflation. Then you also need to consider if we have an opportunity cost. There's a very good chance that when they develop this online platform, a lot of their existing customers who are currently buying printed magazines and newspapers will stop buying the printed magazines and newspapers and instead use the online platform. So they need to perform market research to determine how many customers are going to change or move across from print media to online media. And that will represent an opportunity cost because as a direct result of this investment, they are going to be losing out on income that they currently make on print media. And the opportunity cost should be shown as a cash outflow in years 1, 2, 3, 4, and 5. Then after we've estimated all of the cash flows relating to the investment, we perform a separate tax calculation because we want all of these cash flows after tax. So for all of the cash flows, you need to consider what the tax consequences are. Are those cash flows taxable? Then you need to include them in the calculation. Are the expenses tax deductible? You need to include them in the calculation. If there's any capital or once-off cost, you need to consider what the SARS capital allowances are and include that in the calculation. So after calculating all of the cash flows, perform a tax calculation, calculate the amount of tax that will be payable, and then include that in your calculation. You will then total all of your cash flows. And once you've totaled all of your cash flows, you will discount those cash flows to the present using the target WACC as your discount rate. If the project has a positive net present value, it will create wealth for the company and should be accepted. If the project has a negative net present value, it means that wealth will be destroyed, so the project or the investment should not be accepted. Then, this calculation involves a lot of estimation because management doesn't know with certainty exactly what the future cash flows are going to be. nobody knows exactly what the future holds. So even though they try and predict the future cash flows as accurately as possible, those cash flows are subject to risk and uncertainty. So if we calculate that the project has a positive net present value, we shouldn't just accept that, because there's a risk that there's an error in the forecasts and the project doesn't actually have a positive net present value. Maybe revenue has been overstated, maybe expenses have been understated, maybe the discount rate that's been used is incorrect, etc. So in order to address this risk, they can either perform a sensitivity analysis, a Monte Carlo analysis, or a simulation. All right, so that deals with the first part of the required. We've explained how the capital investment appraisal should be performed. Now we need to discuss other factors that should be considered before investing. So in other words, other factors that should be considered before making a final decision. Now remember, the analysis that we just looked at, or that we just discussed, is a financial analysis. We look at all of the finances. If the project has a positive net present value, we accept. But we would never just accept a project based on a financial analysis. Non-financial factors should also always be considered. However, please note, your discussion over here is not limited to non-financial factors or qualitative factors. The required simply says other factors, which means you can discuss both financial and non-financial or qualitative factors. So it's important to always read the required carefully. Sometimes they will specifically ask for non-financial or qualitative factors. Then obviously you can't discuss costs. However, here, because they've just asked for other factors, we can discuss both financial and non-financial factors. Obviously, make sure that you don't discuss the same financial factors that you have already discussed, because you're not going to be awarded the mark twice for discussing exactly the same thing. However, if there is a financial factor that you want to discuss that you haven't already discussed, then obviously you can bring that in over here. All right, so what are the other factors that they need to consider before making a final decision? Let's start with the financial factor first. If we go back to the scenario, we know that they are going to earn the majority of revenue from advertising and also some revenue from monthly subscriptions, where customers want to read articles without advertising. Now, something else that they could also consider, if you guys have read news articles online, you would have seen sometimes these online platforms ask for voluntary donations to help them obviously cover the cost of the online platform, because a lot of them don't require a monthly subscription. A lot of them, you will see when you're reading the articles, there is a bit of advertising, and that's obviously how they make their money. But in addition to that, they also ask for voluntary donations. So that's perhaps something that Bulletin could consider doing. Then for some non-financial factors, Bulletin is very late in developing their own online platform. Most companies in the media industry already have their own online platform. So they obviously need to consider competition from these established businesses that already have online platforms. It's going to be very hard to get customers to move across from a platform that they're happy with and try your platform. So that's definitely something that they need to consider. In addition to that, because their platform is new, they might have initial problems when they start. So there might be some IT problems maybe where pages don't load correctly, or where people can't see the things they should be seeing, or any number of things can go wrong obviously with the internet. And established companies that have an online platform and have been operating for a while would have already overcome all of these problems. So there's a risk that initially, if there are any technical glitches, that could cause reputational damage for Bulletin, and customers will then rather move across to established companies where they are not experiencing those problems anymore. And then finally, from an environmental perspective, the development of an online platform will definitely result in some of their existing customers who are currently purchasing printed magazines and newspapers moving across to the online platform. And that's the future, guys. That's where everything is obviously going. So it will result obviously in a decline in printed magazines and newspapers, which we will take into account in the financial analysis as an opportunity cost. However, a positive impact for them to consider over here is obviously if more people are reading articles online and less people are buying printed magazines and newspapers, then less paper is going to be used, and that will have a positive impact on the environment.